Hey everyone, Dean here from Pythia Research. Let's talk about Bitcoin's cycle because right now everyone online is convinced it's over. Bears are out in full force, screaming that BTC has already topped, that it's game over, that this cycle is done for. But let's cut through the noise and get to the real story. Markets don't move in a straight line. They never have and they never will. If you're feeling uncertain, trust me, you're not alone. Fear is dominating both equity and crypto markets, fueled by a few factors. One, the non-stop recession fears. Two, the political landscape and uncertainty. And three, of course, our good friend Donald Trump reigniting trade wars and pushing for tariffs. But here's what nobody's talking about. The real hidden force behind every bull market is global liquidity. And right now, liquidity is flashing the same bullish signals that kicked off previous market booms. That's why in today's video, we're breaking down the role of global liquidity in Bitcoin's 4-year cycle, why this cycle is far from over, and how history tells us the biggest moves are still ahead. If you want real data, not just Twitter doom scrolling posts, stick around because by the end of this video, you'll have a clearer picture of where Bitcoin is heading next. Liquidity is the key driver of market trends. Every major bull run has coincided with periods of global liquidity expansion, and this is not a coincidence. It's a direct cause and effect relationship. Central banks inject liquidity into the system, whether through interest rate cuts, bond purchases, or currency devaluation. It increases the amount of available capital in the economy, and this excess liquidity doesn't just sit idle. It flows into risk on assets like stocks, real estate, and most importantly, crypto. We know that at some point this year, the Fed will shift from quantitative tightening to quantitative easing, a move that could inject trillions of dollars into the financial system. This surge in liquidity has historically been the catalyst for major stock market rallies and risk on asset booms. So we are more in favor of QE happening this year. And if it does happen, then I think we will see a massive risk on asset appreciation across the board. And this chart here is the M2 Global Liquidity Index. And it's pretty simple, guys. The trend has been up. And within the trend, we've seen these smaller micro wedge patterns play out. And then we get an expansion breakout of the wedge and then a retest. And then from that retest, we get a major upthrust in liquidity. So that happened in the 2017 bull run. In the last bull run, we had a wedge pattern. We broke out, retest, and had a massive expansion to the upside, which also coincided with Bitcoin's price rallying significantly. And currently, we have a wedge pattern that's formed. We had the breakout, a retest, and now we're just starting to see global liquidity getting above that breakout point, which is extremely important because this is a signal that's telling us that liquidity is rising, which means money is getting injected into the system, which means risk on assets will appreciate. And this chart is showing the M2 growth year on year in green as a percentage, M2 global supply in blue, and Bitcoin's price action in black. And the trend is honestly outstanding. The correlation is very, very, very similar. Every time the M2 global money has expanded, we've had an expansion in Bitcoin's price action. And every time it's contracted, we've had the 1-year bear market. This has happened across the last 2 cycles. In 2020, we had the expansion and global M2 also expanded. And then we had a contraction starting 2022 and Bitcoin's price also fell along with that. Now, from the 2023 bear market bottom, Bitcoin and global liquidity hasn't really taken off. We've seen gradual increases in the price of Bitcoin and global liquidity as well. But it's been more stagnated and more choppy sideways consolidating. We haven't had this real breakout yet, like the 2 last cycles. So in the middle to latter half of this year, we are more inclined to see liquidity quickly expanding to the upside, which should, in theory, cause Bitcoin to also rise significantly. As well, Bitcoin's recent dip is closely tied to global M2 money supply movements, and we're seeing a 10-week lead in global liquidity playing out with near perfect accuracy. Every time M2 expands or contracts, Bitcoin reacts accordingly, showing a clear and consistent relationship between liquidity and price action. So, when M2 contracts, Bitcoin also decreases. When it expands, Bitcoin rises. And when it consolidates, Bitcoin has chopped in a sideways pattern here. And because we've overlaid this 10-week lead onto the daily price action of Bitcoin, what it's telling us is that eventually Bitcoin is going to catch up with liquidity and start rising. So this current sentiment around this price action has caused people to believe that the cycle top is in. But here at Pythia Research, we are not in favor of that belief, and we think that Bitcoin will be much higher in the coming months. Now, the role of the dollar is crucial in this broader picture, and we're seeing a strong parallel to the 2016-2017 period here when Trump gets into office. Now, the key turning point for the dollar back then was mid-January 2017, just before Trump's inauguration, when he told the Wall Street Journal that the dollar was too strong. That single comment effectively set the stage for a year-long decline in the dollar. Fast forward to today, and history is rhyming. Trump has repeatedly expressed his preference for a weaker dollar, primarily to enhance trade and economic competitiveness. A weaker dollar is extremely beneficial for many big global investors and institutions as they borrow in dollar to invest in other assets. For example, China, being also a big global player, is facing millions in dollar-denominated debt that must be rolled over, and they remain highly dependent on the US for global trade. So it's only in China's interest for the dollar to be weaker. And we can see Trump got into office here in 2017, and the dollar only trended down until 2018. So it was 1 year of downwards trend. Same thing here in 2025. Trump has got into office and the dollar has already started to decrease. Now, this won't go straight down. We might get some movements to the upside, but the overall trend we're expecting is for it to be much lower by the end of 2025. So when we look at historical performance of the US dollar, there have been 5 major drawdowns ranging between 12 to 17%. And based on the factors we discussed earlier, there are strong reasons to believe the dollar is heading much lower once again. So if history is to repeat itself, we could be looking at 10 to 15% drop in the dollar over the next 6 to 12 months. And trust me, that's a big deal for global markets. And a weaker dollar unlocks more liquidity, fuels risk assets, and sets up Bitcoin and equities for a major rally. I keep hammering this point home that the dollar and M2 liquidity are key drivers of market moves, but it's important to understand this dynamic here, because if you understand this, you understand the bigger picture and you understand why a lot of risk on assets appreciate and what they actually are really linked to. So we've predicted a 12.78% drop in the dollar, which will essentially bring it down to 94 to 93. And this is a reasonable target. And it will also be taking out these equal lows, which is 2 strong resistance levels which held from 2023 to 2024. So we should expect this to keep decreasing. This chart shows the inverse correlation between the US dollar and global M2 liquidity. So every time the dollar is rising, M2 is decreasing. So that's what we call an inverse correlation, because it's doing the opposite. And we've seen this pattern play out all of 2022 up until 2025. And as mentioned earlier, if we think the dollar is going to go much lower, down to 92 to 94, then what we can expect for global liquidity is to keep rising to the upside. And the next few slides, we're going to be talking about Bitcoin on-chain metrics. Now, these metrics are very powerful because a few of them have allowed us historically to predict when the Bitcoin cycle tops are likely to occur. And one of the main indicators is the Pi cycle indicator. And it's a well-known tool for spotting potential Bitcoin market tops. It works by tracking two key moving averages. The blue is the 111-day moving average, and the purple is the 350-day moving average. Now, every time the light blue has crossed over the purple, we've seen either a top or a massive decline in Bitcoin. So historically, this indicator has signaled a major market peak, and while there have been a few times when the crossover happened without an immediate top, it has still nailed every major Bitcoin bull market peak so far. So back in 2013, we had a crossover, Bitcoin dropped, but it wasn't the top, even though it crossed over. The real top was in 2014, but we also had the crossover. So it has predicted that top. In 2018, we had a crossover here as well, and it perfectly predicted its top. In 2021, we had a crossover here as well, but it dropped as well, the price, but then it rallied up again, and it slightly went above. So I would still call this the top. And currently right now, we have not had this crossover yet. Bitcoin has just slowly, gradually increased over time. And if anything, we're far from the top occurring. Our Bitcoin core risk indicator is nowhere near overbought as well, and we are still sitting in the mid-range, which means there's likely plenty of upside ahead. Historically, Bitcoin market tops have lined up with the market value to realized value X score hitting the red zone. And typically we look for an MVR score of at least 4 before calling any potential market top. And right now it's still under 2, meaning there's likely a lot more room for this cycle to keep running. Is the cycle over? No, the cycle is not over. In fact, we believe there's still plenty of upside ahead. With global M2 liquidity on the rise and the US dollar weakening, conditions are setting up perfectly for risk-on assets to keep climbing, at least through the end of the year. Since Bitcoin's inception, we've followed a 4-year right translated cycle driven by global liquidity, and we believe this cycle is playing out the same way. A right translated cycle means the market peak happens after the midpoint of the cycle, and that's exactly what we've seen in the last 2 bull cycles. Bitcoin has never had a left translated cycle, making it unlikely that we've already peaked, especially with global liquidity expanding. So to understand what a right translated cycle is, we take the previous cycle bottom to the next cycle bottom, and the midpoint is displayed here. If the cycle peak is on the right, we know it's a right translated cycle. So we had one peak on the right in 2018. The second cycle was also a right translated peak. And the third cycle, we had just passed the midpoint here. So this would be extremely unorthodox for the cycle to peak this early. This chart is showing how many days it has taken for Bitcoin cycle top to occur, and it's exactly been 3 years, almost identical across the 2 cycles. So in the first cycle, it was 35 bars, which is 1,065 days, and we had the top in 2018. In the next cycle, 35 bars again, 1,066, and today 35 bars takes us out to the 1st of October 2025. So this is just another interesting thought experiment to see where we could see the cycle peaking based on historical data. And that wraps up today's video. I hope this framework has given you more clarity on Bitcoin's near-term trajectory and provided more of a framework in navigating these markets. So be sure to follow us on Substack for in-depth research relating to the macroeconomic landscape and overall finance-related topics. I'll drop the link in the description. At Pythia Research, we are committed to delivering hard facts and in-depth macro breakdowns. See you in the next video, guys.